I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. The major banks have been rationalising their businesses over the last couple of years due to a need to refocus their operations back towards core competencies and to release Tier 1 capital to help meet the higher capital requirements being imposed by regulators. Both NAB and ANZ have either sold or demerged lower return overseas operations, while ANZ, CBA and NAB have also sold insurance operations. The Royal Commission into Misconduct in the Banking, Superannuation and Financial Services industry has highlighted issues with the vertically integrated structures within the financial advice offerings of the larger institutions. In December, ANZ announced the sale of its Australian wealth business to Zurich for $2.8 billion, with the first $1 billion of the proceeds received in early May. The proceeds for numerous asset sales allowed ANZ to launch a $1.5 billion share buyback, which was increased to $3 billion late last week. In May, NAB announced its intention to sell its MLC wealth management business, including the financial planner network and platform. It will retain its private banking operation under the JB Weir brand and the NAB Trade Securities business. And now, CBA has also announced its decision to demerge its wealth management operations later this year. The surprising element of the announcement was that the demerger includes the financial advice business in Colonial First State, as well as other financial planning and mortgage broking operations. These moves are clearly designed not just to refocus the companies and liberate non-core capital, but to remove one of the key sources of misconduct complaints at the Royal Commission. These banks will have significantly scaled back their exposure to financial advice and exited their wealth platforms. From a financial perspective, the market is starting to get a little bit more excited about the prospect for capital management by the banks, as the proceeds from the sale of non-core assets pushes some of the majors ahead of where they need to be to meet APRA's new definition of unquestionably strong by the start of 2020. However, the sale of wealth management businesses is likely to result in a deterioration in both the rate of earnings growth and the marginal return on capital generated by the majors going forward. The banks were attracted to wealth management because of the exposure to the growth in the superannuation system and the ability to extend their existing relationships into this part of the customer's life cycle. The other benefit for the banks was the low incremental capital required to generate earnings growth relative to the regulatory capital requirements of the core deposit and trading and lending businesses. As a result, $1 of earnings growth in wealth management was generally more valuable to shareholders than $1 of earnings growth in lending. With these businesses having been sold or demerged, the earnings multiples applied to the major banks should continue to decline at the margin, given the slower and less valuable earnings growth outlook. The major that continues to buck the trend is Westpac. While it is largely sold out of its asset management operations, it continues to invest heavily in its BTFG financial advisor operations and the Panorama platform. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.